it is not specifically highlighted in the calendar today what our lesson is going to be, because we are in the midst of rolling out a new curriculum for the XLT program, and we are going to do our lesson today on a much discussed and often frequently asked questions on how to set proper profit targets for our trades. And so I get a lot of emails on this, both in my own individual emails and in the iSupport, and a lot of people have been asking questions about this. So I'm going to do a live lesson today just on talking about the targets. And Sam Evans is here with me today to be answering questions in the chat. What I would like to ask is if that you would allow me to at least get through some of the presentation, and then I will open it up for a question and answer period. I find that it seems to me that we spend an awful lot of time distinguishing where good quality trading opportunities are at, based off of our rally-based drops, our drop-based rallies, looking for those pullbacks and identifying the areas of supply and demand. And many times people are saying that they're comfortable with understanding where they should be getting into the trade. And they even have the concept of understanding where it is that the stock should go above the supply zone or below the demand zone. But one of the things that I frequently am hearing discussions about, and also that I see questions in regards to the most often is oftentimes in the targets. So I want to spend some time doing that today. If we do have some time further in the second part of the lesson, I would like to also answer a few other frequently asked questions, especially this time being rollover period. I'd like to sort of spend a little bit of time talking about those emails that I seem to be getting an awful lot of questions on the contract rollover. And it seems that every rollover period we seem to get more of an influx in this, especially with the new people that are coming into the futures room who may not have ever experienced contract rollover. And this is a part of futures trading, and so it's definitely something that we're going to see a lot more conversations about, and having to make sure that you understand these topics. So both the targets and also looking at the contract rollover is going to be some of the most important highlights of today. There really isn't a specified lesson that is out there on the website today, and so Sam Seid and I talked about it, and he said, you know, there's been a lot of questions also about targets, and I said, yeah, and a lot on rollover. So we've made an agreement that these are the two things that we feel are going to be beneficial for you all. So hopefully you'll find it as valuable as what I see it to be. So I'm going to go ahead and do our normal routine and go through the disclosure first. This training is for educational purposes only. Online Trading Academy's professional staff and employees do not recommend, advocate, or solicit the buying, selling, or holding of any investment, the use of any investment choice methodology, the use of any particular trading platform, the use of any particular broker-dealer. Trading and investing always involves high levels of risk. Any money that's allocated to trading and investing can be lost in its entirety at any time. You alone are the person responsible for any trading or investing activity that you undertake. Demonstrations of trading processes included but not limited to the choice of the investment and making the trade presented during this training are not a representation or a prediction that any account will or is likely to achieve profits or losses similar to those discussed or shown as part of the demonstration or as part of any other training. Instructors may from time to time express personal opinions. However, they're not authorized, nor will they assume any responsibility for your actions. Future results can be dramatically different from the possibilities that are presented in training, and past performance does not guarantee future results. Your participation in this training constitutes an acceptance of all of the above. Just again, a reminder that all the content that is presented to you as part of this training is the property of Online Trading Academy, and it cannot be distributed or reproduced in any form without the written prior consent of Online Trading Academy under the copyright rules. So with that said, just also, again, if you do have questions about this topic or any of the other lessons or live trading analysis days that we do, please send an email to the XLT-Support@tradingacademy.com team. They are there to assist you. Make sure that you include in the subject line SME for subject matter experts. include in there what the lesson date is in the XLT class, and also who the instructor is that helps us get the questions answered a little bit more quickly. With that said, let me go ahead and application share my charts. I'm going to spend all of my efforts on showing you live demonstrations of the different futures markets that are out here, trying to anticipate the moves on the profit targets. And so I'm going to go ahead and start off with making sure that you can see my charts. Go ahead with the green check mark. You should see the gold chart on a 60-minute. Okay, perfect. So part of this lesson, not only with the targets and understanding where to take a profit off, part of this, all goes down under the general heading of money management, trade management, risk management. And so many traders have individual styles that they use in managing their risk, managing their trade. The things that I'm presenting to you are what I feel personally are some of the most beneficial lessons that I learned, and I think that Sam Evans, I would appreciate if you have any comments or anything that you want to add about your own personal experiences with this. But I'm just going to share with you that I personally believe that the best targets come from the larger time frame charts. Okay, and so I'm starting off with a 60-minute chart in an intraday trading basis with the idea that if I'm looking for profit objectives, no matter what chart it is that I use for my entry, my bigger picture time frame should always be the level that I'm looking at for the targets, because that is where the biggest amount of reward potentials are going to be seen at. So it keeps away the risk, and it gives you that reward potential. Now, I'm not telling you that this is the only way, but I'm just going to tell you that from my experience level, and I've been in this futures market since 2002. I've been in the stock market trading stocks since 1997. And I believe that I have enough years of experience behind me that I can offer this information to you freely. The things that I've found is that when I was trading on a 5-minute chart or a 15-minute chart and I was using that for my entry, I also found that if I was using it for my exit, that I was minimizing the potentials that I would have for the profits that were out there. And when I would go back at the end of the day and I would look at what the bigger picture levels were that were out there, that I could have made a lot more money if I would have just used the bigger picture time frame chart. And Jeff Cronenberg, and you all have seen some of the posts that have been coming in the room with him, and he's been talking to us on a pretty routine basis here the last few days. I've had a few conversations with him about this as well. And I'm going to refer back to that specific chart that he's talking about on the Aussie dollar chart as well. But I'm going to give you some live examples of some things that I see that if you could go back and look at what the textbooks are telling you and what we've been teaching you in the classrooms, and then applying it within your live trading, that you'll see that those bigger picture moves are definitely going to be the goal of where you want to be as a trader. I realize that day trading, looking at 5-minute charts and 15-minute charts is very beneficial for day trading, but the reality of it is that you can never overlook what that big picture time frame outlook is. And one of the problems that I see with day traders is, and I'm telling this from myself, that I had this problem, that when I was a day trader, I was very specific to the very small time frames of what was happening, maybe even for just the last day or two or a couple of days. But then I had this such a small microscopic picture of it that I couldn't look at the big picture and see what was happening and why I was sometimes being stopped out of good trades, or that I wasn't making as much money as I wanted to. So as I'm looking at this right now, let's start off with gold as an example of this. And I want to go down, and I want to first tell you that whenever you're looking for profit objectives on a trade, when we're minimizing our risk, just one second. Okay, and so whenever you're looking at getting into trades and you're trying to manage the trade appropriately, as a swing trader, you're looking for the moves off of the swing point lows that created the last move to the downside, and then you're looking to the extreme highs for the swing point where it stops going higher. This whole entire area between here on gold on the 60-minute chart is all part of that last swing. And so that if I'm looking at profits and I'm looking at targets, I'm looking from the standpoint of this entire swing point that the very best entry is going to be down on this low side with the overall objective of getting back up at least to the area from which it last stopped. And I have to think about it in that way because this overall move has been in an upward direction. And this is the last point at which the selling pressure was unable to continue with those sellers, and that if the best area for the lowest amount of risk is going to come my way, this is going to be the level that I want to be looking for an entry, and the swing point high is where I'm looking for the next area that the market could go to for my profit objectives. Okay, now what I see here is that throughout the next couple of days that followed after I'd identified this swing point, I'm looking at this right now, and I'm just trying to point out to you that in any trade that you get into, especially looking at these bigger picture time frames, you're always going to want to look at the swing point highs and the swing point lows in the overall big picture trend. And so what ends up happening is after this high is created, we have lower highs and lower lows. We continue with lower highs and lower lows. Continuation of that move. And while we were not able on the 12th to continue to come all the way back down into this extreme low that had been created on 225, once we start breaking back up above a previous bar's high, okay, this was lowering highs and lowering lows. And once we start to fail to continue with this movement to the downside on this lower high and this lower low, I start to ask myself this question, if I thought that my entry point was going to be here and my next target was here, what do I do now that it didn't even get down into this entry point? And my answer to that question is, I do nothing. Okay, so now I just want to tell you all that this is one of the most difficult things to be able to start to get to a comfort level of, is saying I do nothing. And you can go back to this gold chart, you can go back to Aussie dollar, you can go to the Japanese yen, you can go to the British pound, you can go to the indexes on any of the stock index futures, you can go to the commodities, and you'll find that there were trading opportunities that came along the way on this pullback down. But that if you are truly serious about waiting for the good quality entries with the least amount of risk, with the highest amount of profit potential, you will do nothing until the market comes back down into this area. And if it never gets there, you have nothing to be emotional about because it just never got to that area. Now, with this continuation of a move down, with that being said, I also want to remind you that with these lowering highs and lowering lows that were occurring on this gold contract, if this is an area where I'm seeing that the last sellers were able to continue with selling pressure and the buying pressure came in, if I enter into this trade at a swing point low and it gets stopped out, answer me this one question. Would you continue, after you've been stopped out, continue to look for the next lower levels that were to the downside that were going to be buying opportunities? Once that level is broken, okay? All right, so what I'm going to tell you is that is that my experience has been that once the trend has been telling me that this level has been broken, if this is lowering highs and lowering lows, and this was a holding point where the market was giving me a great area for entry because the market had never been able to break that, and it starts to fail below there, do you all think that if these are going to be lowering highs and lowering lows, let me ask the question again one more time a different way, that if these are lowering highs and lowering lows, we buy into this pullback and we get stopped out, do we still want to keep buying every low that is presenting itself in the future? Okay, and this is one of the things that seems to be a problem with us in our minds, is that we keep wanting to buy because we're looking to the left side of the chart and we're seeing the next demand area. And I'm going to tell you, it's okay to be a buyer at a demand level that has the capabilities of producing a sharp move away from it. But don't forget the overall trend of the market. And so far, that between this low and this high, the market has continued to produce upward movements. And that this pullback would be the very least risk with the highest reward potential so long as that low never breaks, because we will still be in the overall big picture of the swings and the moves in an uptrend. And one of the things that I found that helped me is that when I start looking at this and the area fails, I say to myself, okay, now I have to be aware that at any time that I buy on a pullback after this level has been broken, I have to reduce my amount of contracts that I'm looking at getting into until we come into the next swing point low that is going to be an even higher probability trade. And from this level being broken, any of these little bitty pullbacks that are being created do have the potential of creating a little bit of a bounce. But what are the areas from this overall big picture move from the upward direction? Where is going to be the best level, rather than just taking each of these trading opportunities along the way? Where is going to be the best area? Okay, and I look back to my chart now and I say, well, I can still take any of these buys if I do get stopped out, but the very best level is absolutely down on the lows that were created at on the 5th. Does everybody, before I moved on to the topics of targets, I wanted to make sure that everybody's understanding how important this big picture chart analysis is. And that's why when some of you ask me the question in the classroom, but Michelle, aren't you really then swing trading only at the extreme levels? This is absolutely critical, that if you want to avoid continuously being stopped out, and you don't want to keep taking trades on every little demand level, that you're buying the pullbacks only at demand levels when you're in an uptrend. And once that swing trade area has been defied or broken or violated, however you want to call it, you then have to be able to say to yourself, that was a good trading opportunity if this overall trend continued. And once it doesn't, this downward trend is even probably going to continue to go lower. Yes, each of these little levels as a day trading opportunity are going to be a possibility. But bigger picture swing trade tells me that from this low to this extreme high where that continuation was going on and the move eventually followed out of it, that's the swing point that I next need to be looking at. Now the questions are, how far do you go back? You go back every swing point and you look, and once that new level has been violated, then you look to the left to the next one. Each of these swing points are absolutely critical, and making sure that you're absolutely looking at your entries at the right level, because picking targets is really very easy once you know that you have the trade in the right area. And just like Sam Evans is pointing out, any of these levels that have been previously untested have the potential of producing a bounce. But the ones that have the lowest risk with the highest probabilities are going to be those that are going to be at the extremes. And they're going to be the ones that you're looking for that have had the strongest moves. The strongest move in this particular gold chart, look at this move that happened to the downside and then prices stopped at that level, holding off of it, we've never been able to get back down into those lows yet. And so that from this overall bigger picture move, even though this has been in an uptrend, the distance from this extreme high to this extreme low tells me that bigger picture than even this little swing point is this even bigger move of this that's down here that was in a downtrend. So you have to realize that you've got to learn to take your eyeballs and alleviate the microscopic view and be able to take it out into a macro picture. So now what I want you to realize is that any time that you get into a trade at a demand level, the profit targets, if you are truly using them in the best way, any demand zone where you enter into a trade should have a profit level of the next supply zone as your profit target. So let's talk about this. If this is your demand zone, this is your supply zone, and this is your big picture longer term trend, then if I entered into this trade at 1090, what should be my profit objective on gold as I'm looking at this for a trade entry? Okay, if I were to get filled on this trade, where should be my profit level? Does anybody disagree with me that it shouldn't be all the way back up here at the 1140 level? Absolutely. And you know what? What I would tell you in that is that if you are really good at this, you're only going to start to exit out of a portion of your position at this level and maybe hold on a few of your contracts, because if this overall trend continues and there isn't further weakness, then what should happen with this market? If this gold is really in an uptrend, what should happen if we have bought at the low where the swing point came in? And we do take some profits in case it never gets through the supply level. That's why we take the profits there. But what if it continues to move outside of that? What will we then look for as our next profit objective? Yeah, let me get to the 1130 and the 1120 areas, okay? But let me just, I'm talking about bigger picture. Absolutely, Randy. We're going to be looking at the bigger picture time frame off of that, or going to a 60-minute, that if this level gets broken and I took some profits off here, the next profit objective is going to be up at the 1160-ish area. Does everybody see why I used those two? I'll answer the questions about the other areas, but I just want to make sure that you understand why I'm using these as my targets. So for those of you that have struggled with having questions about where do I take my targets, if you're truly entering the trade at the demand zone, you should be using your profit targets to the next supply zone. Now, you can do this on an intraday basis from the previous day's low to the previous day's high. You can buy the demand level low. As long as it never breaks below previous day's low and you're in an uptrend, you can buy that previous day's low. And then, as long as it gets back up to the previous day's high, tell me what it takes in order for an uptrend to continue. Hiring highs and hiring lows. So remember, when I've used in the examples numerous times that I'm simply watching the market as it comes back into the Globex lows or coming back into a previous day's lows. That's why I got to give it that wiggle room of a 3-point move on the S&P, because it might not get all the way back to the low. It might create a little bit of a higher low at that level, entering into a demand zone, but the whole goal of that day is to get right back up to the previous day's high, and even extend further, because if it extends further, then it'll be putting in higher highs and higher lows. Okay, now let's go in here. Conceptually, this is understandable. However, you need the big bucks to trade like this, because the levels are huge and you're not just talking about 3 points. It could be 10 points. Well, Cape Ann, let me talk about this a little bit further. Let me first address the other questions, and then I'll get to that. I'll get to that question about the bigger bucks, because yeah, this is the analysis that you're going to absolutely want to get to, and when you do start feeling comfortable enough with it, I'm going to show you this on any kind of a time frame, okay? So what I'm doing here is expanding this out now. And for those of you that asked about the question on the 1120 and the 1130-ish areas. Okay, so here, down at this 1090 area, I said, what would your first profit objective be if you were looking at this from a swing point? And I was talking about the 1140-ish area, 1145 area. Somebody said, well, what about the 1130? Now, this level had not been created from the time that this move was put in. And now that our entry point had not been triggered and we did not get a fill in it, this level is going to be an important area, Jeff Cronenberg and the rest of you that were asking about this 1130 area. The market is going to absolutely have to get to this area. So what I'll do instead of just automatically taking off trades at this level is I will watch as price action is approaching into this area. And I will just continue to hold on to it as long as I don't see some further failure with a new double top pattern and some basing and a failure to continue to break through this high. I would continue to hold on to it. But similarly to looking at this extreme move from 225 high to the extreme high of 3.3, you can do this style of trading with any time frame, with any swing point high and low. So let's erase those time frames because they are bigger picture, because they are bigger time frames, and they are bigger risk for some people that don't have as much money. So let's do this. Let's go down and think about other swing points that are on the chart right now, okay? And talking about this not only on a 60-minute, but going into the 5-minute. But here we're going to start right here with this swing point low that was just put in. From this swing on this high to this low, the market just put in a new low that was put in on 312, and so far we don't know where this move is going to continue to go to, but we'll see more detail as the days follow. If you're looking at this and you're saying to yourself, what if the market only comes back up to the high of this 1130-ish area? And then we start to see some further failure. We'll wrap some lines around this area. So this being the swing point low of the demand zone, this being the swing point high of the supply zone. Obviously, we know there's a bigger picture swing that we're right in the middle of, but for the time being, over the last couple of days, this is what we see. Now, if the market comes back up into the supply zone, how many of you as a day trader, okay, we're talking very small term, we're only talking about 3-4 days of trading here, how many of you would be willing to enter into a trade short in between this supply zone high and the low, putting your stop up above this high, and then looking for a profit objective back where? Where did I say that we should be looking at it to go to? All the way back to the area from which it came down at 1100. Now, is this starting to make a little bit more sense and why it's so important to look at the swing points? Because what you've done is you've encapsulated this area for where your entry is, and you've said to yourself, okay, this is the maximum that I'm willing to risk, is the level between this lower level of the supply zone and this higher level of the supply zone. This is the maximum I'm willing to risk. And I know that if it goes above here, I'm out. Why am I out? Because on this bigger picture swing point, I'm not going to be willing to enter back into a trade again until it starts to come back up into those swing point highs. Now, somebody would say to me, why wouldn't you be looking at 1140? Why wouldn't you be looking at some of the other levels that are here? I answered that question earlier in telling you that is because from the swings that were created, this was the extreme low and the extreme high where buyers stopped buying and sellers stopped selling. This started to tell me that there was a pullback, possibly downtrend. And so I'm going to avoid, personally, as a trader, I'm going to avoid these levels in between. And when you all are asking me why one level is better than another, that's why. Okay? Now, as you're looking at this and you say to yourself, here's my entry, my stop is above here, and this level of where the next trading opportunity at demand is going to be where my target is. The reason is because, as we've talked about before, the amount of time that it spent at any of this level, we just continue to have buying pressure, and the path of the least resistance, if the market does not have the capability of going higher, is to go back down to the level of the lows which it came from. All right? So I just want to make sure that everybody in here is feeling a little bit more confident. Now we can do this in any time frame of a chart. So before I move on with this, I'm going to go on to some other time frames. I'm going to go on to some other examples. But is this starting to make a little bit more sense about the reasons why we're using these targets that we're looking at? We've always got to be aware of where the swings are at, and that we're trying to get into the trades as close to the highs as possible on a supply zone sell with a profit target back down to the demand level. Okay? So let's go over into another market now, and we'll go and start looking at some of the other time zones as well. This is just a really good example of how you just want to be making sure that you're capitalizing on these trades. And the day trades will work for you. You can go in and do the same style with day trading. It's just that you have to make sure that you're following the same kind of rules that you're looking at on the bigger picture time frames, on those smaller time frames as well. So let me go in and look at the S&P here. And I'm going to look at that CL chart that somebody asked me to look at too. But let's just go in right now and look at what's been happening and how important this information was to me in the past. And I don't know if Philippe is in here today, but he sent an email a few months back asking me about this overall trend in the market in the upward direction. And I've talked about it a few times because he was asking me, what are we going to do? You know, how will we know if we should be taking sells up at each of the next high levels, or should we be looking for pullbacks in this overall uptrend? And I told him that you're only going to be taking trades at the extreme points on these highs because that is an area where the market would have a capability of turning. So let's go back and look at this. Bigger picture moves from the extreme range that we had off of the low that was being put in on 2.5. Okay, this is back in February. And at the time that this market had put in this bottom, we looked back to the swing points that were created where buying pressure continued. And then we're going back up here and we're looking at the moves that have continued. And all we have had virtually up to this point where the market had this move to the upside and then a little bit of a basing, all we had was little tiny pullbacks and the failure to ever get back down into these lows. Since that time, after the high was being put in up at this extreme point, we had a little bit of a pullback, and we talk about this. We talk about how the market has some selling pressure, and that if the selling is going to continue, that we should see continued weakness back down into an area from which it came. So look at what happened here on this movement up from 2.5. We've continued with hiring highs, hiring lows. Then we had a lower high and a lower low. And when the market had the failure of being able to continue with selling pressure, to go back down into these extreme lows, it has continued to move all the way back up, not only to new yearly highs, but also breaking back up above highs that had been put in quite a while back. We were looking at 1148 as that extreme high level way back in the beginning of the year. So we have to make sure that with these lowering highs and lowering lows, that the best quality trading opportunities for us are going to be on those extreme pullbacks. On the 60-minute chart, we would have looked for a potential retest back down into these lows. It never came back to that area. So what do we look for now when we see that there's this lower high and lower low that came in? Do we still look back to this low? When we've had weakness, do we still look for this extreme low as a possibility of an entry? Yes, bigger picture we do, but what happened right here? When the last sellers came in and sold, then we've seen some buying pressure, and we've seen a continuation of a move to the upside. Outside of that area, when you were looking at this and you're seeing that previous bars highs are being taken out with new higher highs and higher lows, and especially once 1111, 1115 area got taken out, what should have been any trader that is looking at this market been thinking as a profit objective? From this point, once we see that the failure continues to produce lowering highs and lowering lows, once we break out of this extreme range, what should have been the next level that we would be going back to on the left side of our chart based on the swings as our profit objective? Absolutely, Jeff. Absolutely. And you just go back into that 1148 area. Now, were there any stalling points along the way that the market had to potentially come into? Yeah, because every day that it produced a new high, the market had the capability. And as a day trader, you might have wanted to take a trade up into that daily level. But when you look at this swing from this extreme high to this extreme low, and you see that you're in the middle of this range and it cannot further continue to fail off of these lower highs and lower lows on this pullback, you have to be thinking that it's going back up into 1148. And similar to gold, when I told you that you can exit out a portion of that for your profit objectives, I said you want to hold on to some of it in case if it has a further continuation of that move in that overall uptrend, because then it will be continuing with higher highs. All right? 1067 in October 26, 2008, is that a level to look back for as supply? Well, the level that I'm looking back at, and to answer that question, and I'm gonna go into a daily chart here. It's actually 10.3, one of the levels that I'm looking back at. Okay. Now, as I go back into that 1148 level and I start to back up my charts, I'm trying to identify an area where the market has the capabilities of potentially going back to. Now, on a smaller time frame basis, and just looking at this only as on a daily intraday level, I see this 1175, 1173 area as a potential turning point. But what do you all see as the bigger picture levels that we're talking about from the extreme ranges where the last buyers were buying and the selling pressure came in? Okay, if we're truly looking at this bigger picture between the swing points of the highs and the lows that were being put in, don't you all see that 1175 is an okay level on a daily basis? But when you go back and you look at this bigger picture, this market has the capability of going all the way back up into that 1300 level. And so long as we continue to have hiring highs and hiring lows, if you were still holding on to a portion of a position and you were looking at this, you could say, yeah, I know 1175 might be an area where the market could stall. But once it gets through that level, if I'm still long in a trade, I have that capabilities of getting to 1300. So for the person that said, yeah, this is nice objective information, but it's not realistic for people that don't have a large account. Well, let's go down into a smaller time frame and talk about the same exact concepts, only narrowing down the time frames and looking at it on an intraday basis. Okay, and again, we're just using the same exact analogies that we've talked about in all of the XLT sessions from intraday trading. We're always looking for higher highs and higher lows. We're looking for the swing points to help kind of guide us and gauge us in the direction. And when I look back at this S&P, from the time that 225 low was put in, there's not been enough conviction for me to the downside to believe that this market has made a direction to the downside. But yet, was there any money-making opportunities on an intraday basis to be able to short the market? And the answer to that is yes. If you are truly looking at swing point highs and swing point lows, swing point high, swing point low. Okay, and all I did in this trading day is looked at the low of the day and the high of the day. Now, in an overall uptrend, are we going to be looking to buy pullbacks, or are we going to be looking to short up at the highs? Well, the reality of it is that in an overall uptrend, if we're being professional traders, we're waiting for the buys of the pullbacks. And so let's look at this. You know, as we start to see this basing action that's happening, the market goes into goes into the level, coming back down into a demand level. Sure, it takes a couple of days to get back down into this demand level low. But once it gets back down into that demand level low, again, expanding this out, you can go in here and wrap your lines around these lows and the basing that happened into it, and you can see that the market starts to come back down into those lows. This is why you have to be not so picky and not so precise in exact entries. You can't just say, well, the only area I'm going to get in is at 1131 low or 1132 high. Sometimes you have to be willing to give up a little bit of your profits to get into a trade a little bit earlier in case it doesn't go to the extreme low. And here being a higher low, coming back into a swing point where the last sellers were selling and there was a sharp move in price away from it. Any of you that were looking at a day trading opportunity could have entered into it on a pullback somewhere back into that 31.50, 32, 33 area. Market since that time has never been back, and once it broke out of that high where the swing point of 1144 was, that was more than a 10-point move. So even for those of you that are only trading one contract, two contracts, this is what you're doing. You're watching the swing point highs and the swing point lows, not only on a daily basis, on a weekly basis, a monthly basis, just so that you always have an idea of where the bigger picture outlook is coming from. And when I'm looking at this right now, since this 1131 was put in as a low, 1144 was put in as a high, we've broken out of 1144, never been able to break below that 1131. We got outside of it a little bit and pulled back down into it. And from this time that the market had the last sellers selling with a rally, base, and a drop, the failure to get below this previous swing point low, I say to myself, now if I got into a trade, I'm going to be looking for the best buying opportunity as it comes back down into this 35 and this 40 area. Sure, the market's already moved away from it, has never even gotten back to it, but look at the sharp move in price away from it, and when it comes back down into the swing point low, that's going to be the better trade for me. Okay, now, are there any other opportunities that you could be taking? Well, I'm going to tell you that as long as the market continues to put in higher highs and higher lows, and it does not have the capability of giving me any kind of a setup to the sell, I'm only looking for pullbacks. So you are not going to take as many trades using this style and using this approach. But what you will do is you will stop having frequent stop outs and over trading. You will stop paying too many dollars to the commissions and to the brokerage firms. And then you'll have the probabilities of getting into really good quality trades that are going to produce really, really nice moves for you with high profitabilities. Now, you're not going to be just solely trading one market. You're going to want to realize that when you do this, you're going to look at all these different markets and you're going to wait patiently and be disciplined for each of these levels. So that's why I spend so much time talking to you and saying that I think that the important thing is that you can cover up whatever this ticker symbol is, and you can also cover up whatever the time frame is. If you're truly good at this, you'll be able to get to the comfort level of identifying where those swing point highs and swing point low extreme points are and just sit there and wait patiently for them. Because you know that if you're a buyer down at this low and you're getting into the trade, you're going to go back to the next swing point high to look for that as your profit objective. You have very little risk and you have very large gains potential. Okay? Now, looks like there's a couple of questions here. Either of the Sams are in here. Hopefully they're going to be able to answer that. But again, if there's anything that either of you want to join in with us, I just find that so many of you all are having questions in regards to the targets. And I think that the biggest challenges come from the targets is because you're looking at all the little levels that are in between. And the reality of it is that we simply want to find the swing point lows and the swing point highs from the move that was created, and where we're looking at entering into the trade for our profit objectives. And once it breaks out of that level and continues, you still have a portion of your position to continue to hold on to. Okay? Now, let's move on into, somebody asked me if I'd take a look at CL. And I'm going to go into an even smaller time frame chart than a 60-minute chart. But right here on CL, I'm just going to use this as an example. And this is exactly the way that I do. Your eye will become trained that if you start to only look for the extreme point highs and the extreme point swing lows, you will start to forget about all that other stuff that's in the middle of it. So from the extremes of the swing that was created on CL on a 60-minute chart, if I were looking at this, I would be saying to myself, the very best selling opportunity, is going to be when the market comes back into this previous high that had been untested, had a sharp move away from it that was followed by a rally, base, and a drop. The best trading opportunity for me on CL is to be entering into this trade on a pullback into it. What has happened with CL today is that it's moved right back into this level on the 60-minute chart. Now, for the person that says that this works well when you have larger amounts of money, again, you can trade with one contract and see this on any time frame and just look for these swing point lows and these swing point highs. Now, if you get into this trade at 82.65 in between this supply zone low area of basing and this high that's been created out there, all right, and you look at this area, you say to yourself, now, I am going to get into this trade between 82.65, the high is 83.16. I have 55, 60-ish cents at risk in this trade for a profit objective all the way back down into 79.50 area. And that is truly what I would be looking for if I'm going to be looking for good quality targets. Okay, this was the first target that you would be looking for, the move from this extreme high to this low. Now, are there going to be any speed bumps that could potentially interfere with my market giving me that full profit potential? Absolutely. Any of these lows that have been created, little bitty points of lows that were in the way, do have the potential of being a speed bump and slowing things down. But the reality of it is if you're truly patient and disciplined, you will wait for the supply zone sell and you will get into the trade with a target back down to the demand zone low. Okay? And as I move out of here and I go down from the 60-minute chart and I look at this on a 5-minute chart, you can see that on the smaller time frame on this 5-minute chart, okay, let's do the exact same thing. Taking our entries, basing that off of the extreme low that had been put in. This was put in the overnight session on CL. And up until this morning's open, we come up to this swing point high. Okay, we wrap around a level. We see this is the entire move of the swing high and the swing low. We wrap around lines around those levels. If we had done our homework, we would have been putting in the extreme lows. And we would have said, I will be looking for a sell zone between this extreme high. Excuse me, let me erase this one. And move it back up here. And then I'm just going to be looking at this. Now, I don't know if it's going to get all the way back up to those highs, but I know that I have the least amount of risk as the market comes back down into this low. I will take a demand zone buy, and if this is truly going to be a continuation of the move in this overall direction up, then I should at least be able to get back to the area from where this move originally started, and if I can get through it, I am even more profitable because I take a portion of my profits off at this area. Okay? Now, one of the things that concerns me always is that whenever my swing point higher lows that had been holding in an uptrend get broken. Does anybody remember me having these conversations about my smoke signals? Okay? You see this right here? We have an uptrend. We have an inverse head and shoulders pattern that's happening up here, a reversal pattern up at the top. And so while I will still take this buy, I have to say to myself, if this continues to produce lower highs and lower lows, what's going to be the confirmation that I no longer want to be a buyer at these demand zones until I get to the next swing point low? A break of this extreme low that had been put in the overnight. Now I have a low risk trade, and if I never get back up there and it starts to get below here, I also have confirmation that the move is no longer going to continue in the upward direction because we have lowering highs and then lowering lows. And a failure below this low would tell me that there's a pretty good chance we'll even go lower. Okay? Could you give us your rules for taking your first, second, and third targets? Are you taking the first target at 2 to 1? Okay. Now, the reality of it is that there's differences in the accounts that you're trading in. Sometimes you might be, you want to get to the point as a trader that you'll have multiple accounts, that you'll be able to have a bigger picture time frame account that is for your IRA account. And then you'll want to have another account that's going to be for your middle term, maybe just profitable trading that is taking place on a little bit smaller time frame than weeks to months and maybe just days to weeks. And then finally, you'll want to be having an account that you're looking at that is going to be more of an income producer that's on a regular routine basis. But the reality of it is, to answer that question, Beth, on the targets, my target objectives vary between whether I'm looking at getting into a day trade versus looking at getting into a swing trade and looking at a position trade. Many times, which of those is going to give me the biggest reward potential profit-wise? I might have 10, 20, 30 to 1 on my profit objectives in my bigger picture. Looking at that 1148, for example, coming back down from the lows and a breakout of that 1115 area, I had a really decent move that I could hold on to it. But the reality of it is that I might only be able to get on a small picture time frame on a 5-minute chart 3 points on the S&P if that's all that there is in a swing. That doesn't constitute enough of a move for me to really be considering that a good trade. I want the swings to have enough of a movement in them that I'm considering taking this trade. So I like to see, in the markets that there's at least a 10 or a 15 point move between the lows and the highs that I'm starting to look at taking those trades into. Okay? Hopefully that answered that question, Beth. But the best thing to do is just set down a set of rules for yourself as a trader and follow that every time. You got to look at these charts back in time and see what you have been able to see has been happening. And then when you're going into the future and looking at it, you say to yourself, well, this is what has been happening. I'll use my ATR of 11 to 12 points on the S&P over the last couple of weeks as a gauge of what I can expect reasonably on a daily basis. I'll look at 30 or 40 points a week as an ATR on that same exact instrument to say, well, that's what I could reasonably expect on a weekly basis, and then look at the average range that it's been putting in on a monthly basis as well. So when you're trying to look for reasonable profit objectives, you got to know what the market has been doing over the last few weeks or months to kind of give you the idea of whether you believe that this is reasonable or whether it is something that is out of reach. Okay? Okay, Beth says, I find that I'm stopped out before the price reaches the 3 to 1. Okay, this is an example right here, and it's also going to answer the question that's going to go along with Tony's question. This is the third time up at 82.50, 83, and falling might be the time for the short. Okay, if you had identified this level as an area for an entry, because this was a swing point, and it pulled back down into this area, you don't know that this is the extreme high on this pullback because this is still part of higher highs and higher lows. So for me, I'm not willing to take this trade. I'm trying to guess where I think that the market is going to turn. I'll let the breakdown come. And so for the person that's asking, Tony, that's asking about this 82, 83 having been tested 2 or 3 times. Yeah, it's been tested 2 or 3 times on a 5-minute chart, but it hasn't been tested 2 or 3 times on a 60-minute chart, and it definitely hasn't been tested 2 or 3 times on a daily chart. So for me, because of this weakness that I seen off of it, if I got into a trade long on this level and the market got back up to this area and I'd taken off some of my profits and it could not continue to fight through these highs and started to show some further weakness, then I would be happy exiting out of the entire position. Okay, so my profit target is initially here to hold on to some of it for a further move outside of it in case that continuation happens. But if it starts basing into a supply level where I might otherwise already be interested in shorting it, and I start to see that weakness happening, I can just exit out of the entire position. Okay. Bob Voorhees was saying, I remain among the unenlightened regarding the benefits of the 107XN for historical analysis. Could you please address my earlier question? The SPY, the ES, the INX all seem to correlate when comparing today's levels with 930.08. 107XN does not, so why should I pay attention? Okay, we're going to talk more about those contract specifications as we are moving into the second hour. I told you that that was going to be a further discussion, but I'm going to answer it just outright in saying that any historical level that has been out there that is on the contract that it was created is of more value than any other area that is any other chart that is out there, because you have to know where the actual highs and the lows were being created. So that's the reason that we pay so much attention to that 107XN contract. It shows us what the actual prices were during that contract historically. Okay, and that's only for TradeStation. Thinkorswim, eSignal, you know, many of the other trading platforms, this isn't a consideration, but this is definitely something that we have to show, because these are the this TradeStation platform is not showing the actual prices, where other platforms are showing the prices. So let's move on away from CL. Before I finish with this, we have about 5 minutes into the break. I just want to make sure that everybody is clear on the value in looking at these swing points, extreme highs and lows, on any time frame. Identifying the lows and the highs that are in those extremes, wrapping around your demand and supply zones, knowing where the stop has to be, and then using the other side of it as your profit objective for your target. Does everybody understand why I'm doing that? And can you see the value now in understanding this information? And I know that, you know, for me, the best thing to do is always just to go back and see where are the levels, where are the swing points that are lining up on a 5-minute chart, on a 15-minute chart, on a 60-minute chart, that are all lining up at the same area. Just the same as I like to see that my stocks are moving in the same direction as my sector and as the broad market, I like to look at the time frames, and the same way with these futures markets. We have to use multiple time frames, and if I can see that this is a high of a swing point on a 5-minute, and then I go to it on a 15-minute, and I see it also on a 60-minute, this is why that level is going to be so much more valuable than any of these other swing points that are going to occur along the way. So I just want to make sure that before I leave to go on break that there are not any further questions about the reasons why I'm doing these swing points as my analysis and my extremes. Yeah, I'll look at Aussie dollar because I did mention to you that I was going to talk about that. Jeff, that Aussie dollar trade, was that on a 60-minute chart, because we were talking about that earlier? Or was that on a daily? Oh, it was on a weekly. Thank you. Okay, so again, this is just to offer credibility to the same exact concept, only on a bigger picture time frame. We looked at it on a daily, we looked at it on a 60-minute, we looked at it on a 5-minute. I'm doing the exact same thing. Like I said, I can cover up the chart on the time frame and I can cover up the symbol. All I simply want to do is train my eye to go back to look at the extreme highs okay? And go back to the extreme lows. Whoops, hold on one second. Looks like my charts have froze up. All right. And going back, and obviously on the weekly chart, you're going to have a bigger risk than you will on the 60-minute and the daily. Okay, you see that swing point low, you see that swing point high. Now, if you had waited patiently and you had been sitting here looking at these extreme highs and these extreme lows, look at what has happened with the Aussie dollar. It's come back up into this extreme high, had a slight pullback. Can anybody hear me, or did I just lose internet connection? Go ahead with a green check mark if you can hear me. Do you still see my charts? All right, perfect. It's showing my TradeStation was disconnected, so I just wanted to make sure. All right, so what I'm seeing on this Aussie dollar trade is that we've come right back up on this weekly level into an area that had been a previous rally, a base, and a huge drop. Now, we've been talking about this trading opportunity for quite some time, and you can see that it has come back up into that level. And while it hasn't had an extreme move to the downside, we still haven't been stopped out of it if we were waiting patiently on this as a swing trade. So again, this period of consolidation, here being a rally, this being a base, and the longer that it sits here in basing, the less I like it, but I still am not wrong in this trade until it gets me out of this trade above the previous high of that supply level. And I just cannot, I cannot tell you enough about how important it's going to be that you start to get comfortable with identifying these levels and seeing these pullbacks, just like what we did on CL when we were just looking at it and you were looking at that inverse head and shoulders. When you start to see a break in the trend and you start to use your smoke signals, okay, this is an extremely steep trend line here. But you can see that when you're drawing your lines around the bottom and this basing action that happened out of it, okay, after a rally base drop, we had a drop base and then a possibility of a further rally outside of it, breaks out of this level, pulls back into it, has the failure of breaking below the lows, and then continues a nice solid move up to the upside. Now, I don't know if that's what's going to happen with this or not, but I can tell you that so long as Aussie dollar never breaks up above this high, and once I get the confirmation, while I'm still into this trade short, once I get the confirmation of this basing pattern breaking, then I'll have a pretty good comfort level that in time we could eventually get back down into those lows. Jeff says the Aussie dollar seems to test the extreme prices. It makes sense to wait for those 2008 highs. And again, it's all going to be based on risk management and money management, but the reality of it is you can find this on any time frame, on any chart, and any instrument that you want. I don't care if it's the yen or any stocks or the commodities, anything that's out there, you'll be able to use this as your profit objectives. That when you get really good at saying this is the extreme highs and the lows, I'm going to wait patiently to buy down at the lows, and I'm going to wait patiently to sell at the highs. Are there going to be any turning points along the way? Yep, they can be. Drop, base, drop. But the reality of it is when it gets back up into this drop, base, drop, the next time that it comes up here, if you're going to be a seller, look at what ends up happening. It blows right through it. So just be really conservative and be patient waiting for those trades based on the swings, on the extreme levels, on any of your time frames. All right. I'm going to go ahead and, if there are no more further questions, I'm going to go ahead and take a quick break in here, and then we'll spend some time going over some more of this with some of the other markets and talking a little bit more about some of those questions that we see so often coming in on contract rollover. So I'm going to go ahead and take a break, and I'll be back in here at 1/4 after. Turn on the recording, the mic is on, and let me go in and application share the charts again. Okay, you should be able to see the same chart that we ended up with on the Aussie dollar. Just go ahead and make sure that everybody can see this. I, again, just want to make sure the connection is there, so good. All right, now I want to spend a little bit more time talking about the profit targets in different markets and things, but I think that we've done a pretty decent job trying to further explain what it is that we're looking for and how we can reasonably identify the profit targets and the importance of understanding the bigger picture time frames and what's happening off of those. So I kind of wanted to address, there's one question that just seems to be out there this last week and a half now with this contract getting ready to expire here. And so I wanted to spend some time talking a little bit about that first. So I'll go back and look at some of the targets, but I do see that there's an awful lot of questions. I am going to bring up the S&P with the continuous contract that is labeled at ES on one chart. And this is going to hopefully be able to answer many of your questions on the value in the 107 XN contract. We're going to switch over from the at ES, then we're going to go to at ES equals 107 XN. And I'm going to put these two charts side by side next to each other. I'm going to extend them down a little bit further so that you can see them with their prices. And at the exact same time frames, I'm going to be going back and looking at the differences and the reason why we use them. Okay? Now, what I want to share with you is that on the at ES, this is a continuous contract that has adjusted prices off of previous contracts. What does that mean? That means that as soon as March's contract expires on Friday of this week, any of the highs and the lows that were out there that were put in on this month, last month, and the month before may appear to be different as you move forward in the days and the weeks and the months ahead. Because of the adjustment of all of the gaps, they are going to take away, Michelle, you need at ES? Oh, I see what they did. I have the interval. I thought that I had that. Thank you very much. Okay, what they will do is in the adjustment of these contracts when expiration occurs, they will remove the gaps. Okay, and so any gaps that were occurring will not be seen on the chart. Now, if you look at the difference between at ES on a weekly chart, and I want to specifically address your question, Bob Voorhees, on the date that you were asking about. It was back into 2008, and I believe it was in October. I don't remember the exact date, so could you just repost the date? No, Jim, you might not have been in the room lately. Okay, so it's September 30th. Okay, is that right, Bob? Because Tom Schlotek has August 30th, and I want to make sure I'm on the right date. Might have been a typo. So let's go back on this chart, and let's go into 2008. Okay, and let's look at 9/30 of 08. All right. So, I just want to get in the right vicinity. And here is 10/3. Here is 9/26. So we need to switch this over to a daily chart. And this one as well. And I believe I'm still in 09 here. Let me back up a little bit further. And here is going to be September. Okay, so September 30th. Drawing a horizontal line across the high of September 30th. Okay. Now, that high on September 30th is 1154 quarter. Is that what you all see? $930.08, I have 1154 quarter according to the high. And so this level is just a little bit off. I'm not sure which number it's picking up. But according to the highs, I see 1154 quarter. So I'm actually going to type this in here. Now, if we move over and we go to the exact same chart, only we're looking at the 107 XN contract, and we back up to September 30th in the same exact time frame, and I go back and I look to make sure that I'm on the right date. There's 9:30. Here's my horizontal line across the top of it, and I look at the difference. So I look at this and I say to myself, the high is 1175.75. Now the only reason that I am looking at, yeah, that's why I have 1154 quarter here. This it says 1154.21. I'm just putting 1154 quarter. So the only reason that I'm using the 107 XN contract is because when these contracts are showing the charts and the candles and the bars that you're looking at on a daily basis or a weekly basis, and you're actually looking at the contract month in which it was created, it only shows a few weeks or a few months back, okay? It doesn't go back historically months and years. It only goes back a few amount of time. So there might be a little bit of trading activity that was happening before it and nothing years before it. So there's no way that on a contract, unless you physically switch back and forth between at ES and having an ES contract back in June or September, excuse me, of 08 that would say ESU08, that you would be able to know what the actual contract trading prices were off of September's prices, or off of the Z08 contract to know what the September prices were. So the reason that we use the 107 contract is so that we don't have to keep going back and comparing that is this really the high of 1154, or was that high that was created really 1175.35? In reality, the high was not 1154.25 on September 30th, 08. That's what it says on this chart, but that wasn't really the high of that day. And so if you're finding that you can take a trade at 1154.25 and that this level stands up and you don't have to wait for 1175, go for it. All right? But what I found in my experience as trading this market has been that if I stick to the actual level of that 1175 high that was out there, price will typically blow through this 1154 area and will have a higher probability of trading and reacting off of the 1175 as supply rather than at the 1154 as supply, because a whole bunch of gaps were removed from this chart and is not the reality of where prices were being traded at. All right. Now, Shibhup is saying, does any group of traders follow only the adjusted contracts? Okay, well, the reality of it is that that's what got me into trouble as being what I considered at that time to be an amateur trader. I can't tell you the number of times when I'd go back in my log, in my trading log, and I would find that every time that contract rollover would come into play, and I would look at the contract and I would be using one contract supply and demand zones because that had been a previous level, and then the new contract came out and I forgot about the old contract prices, that I was taking trades on the new contract and the continuous adjusted contracts, that if I would go back in my log and say, well, hello, if you would have just used the level off of the supply zone that had been created on the unadjusted contract, you would have never had a stop out. So, you know, this has just been my experience. And this did happen with TradeStation. I've used TradeStation since 2003. I also have eSignal now. That's one of the reasons that I added eSignal. I really like a lot of the things that the charting platform has of TradeStation. But one of the things that I liked about eSignal was that I didn't have to keep going back to the unadjusted contract and find out what the levels were. So now, if you use supply and demand, and I know Bob Voorhees was specifically asking about the SPY and the INX and the S&P. Now let's talk about this, okay? The SPY and the INX and the S&P futures market are all derivatives of the cash market. And the cash is the big dog of the S&P. That is not a tradable contract. Okay, you cannot trade the cash contract, but you can trade the S&P futures, you can trade the S&P exchange traded fund, and you can trade the big contract down on the pit. So the reason that we're using this is for historical data. We're using the 107XN contract for historical data. And during the time that the market was moving down, this 1175.35 area was the true historical level at that time. If I switch off of @ES and I go to $INX, okay, and I switch back and I go to the exact same time frame and looking back at September 30th of 2008. Okay, here it is, the high being 1168.03. All right, wrap my line around the high of that. And so what this tells me is that on the INX chart that the market has a high of 1168.03. And as I go forward with this and look at where we're trading currently, have we gotten back up above it? No, we're coming into it. And I cannot tell you that the market is going to continue to go higher, but I will feel much more confident that if the INX is coming into 1168 at the same time that the S&P is starting to get into 1175 and the SPY is coming into a supply level, that would be a better trading opportunity. Okay? Bob Voorhees is saying again, the $INX, the @ES, and the SPY are all in sync for the 930.08 versus the 317.10. We're not talking about 317.10. We're talking about the level that was created historically, Bob. We're talking about the level that was created on 930 on each of these different markets. Now, I'm not trying to predict that there's going to be a change in direction at 1168. I'm not trying to say that there's going to be a change in direction at 1175. In fact, what we've talked about in the swing from the daily extreme high up at this 1300 down to the lows that were created back even into the 650 lows, there is a stronger possibility that we could even go higher than 1175. But the reality of it is that you need to know that those levels are out there. If you just blindly go into the belief that the market's trading above 1154 means that this is just going to be continued strength, and then all of a sudden the market comes up to 1175 or 1170 or 1173 or 77 and starts stalling off, and you'll be saying, I don't get it. Where did that level come from? That area is nowhere on a chart. It doesn't make any sense to me. And I'll say to you, well, if you go back to the actual contract that it was traded on, that was the high during that time. Now, if you go to SPY, because Bob is asking about SPY and going back to looking at it on the 930 time frame, okay, of 08. Backing it up a little bit further and going in and trying to find that September 30th of 08, okay, right here. This is just a high on September 30th. Is this the move that created a huge downward movement in the market? Is this 930 high an area of supply? Somebody answer me this question. Is in this overall move of a downward trend any kind of a big area that we need to be really focusing our attention on the SPY? Or is there another level that's even a little bit higher that might actually offer some area of resistance or some kind of a selling pressure once it gets back into it? The reality of it is that from the time that this market had a rally back up in price, the last buyer bought and the selling pressure came in, and it has never been back up to that high. Now, if we were discussing this level, okay, and we're talking about this right now, you see this 1116.69 high. Let me make sure that that is the extreme high. It was 116.74, excuse me. Let me just put that price down here. 116.74. All right, that was the high on the 30th of that year. Now we might be penetrating through that low, through that high, but the reason is because even though this is penetrating through that high and it's breaking out of September 30th highs, we haven't gotten into the 1175 level up at the 930 highs on the XN contract, and we're just now entering into it on the INX. But the reality of it is that's not really where I think that this market has the biggest potential of turning anyway. Okay? We look at the unadjusted contract. I can only say this so many times the same way. We look at the unadjusted contract so that we know what the actual highs and lows were during that contract month trading. We do that so that we know what the historical highs and the historical lows were, and we do that so that we're looking at trading the proper levels, not levels that were truly not the number that was being traded at that time frame. Okay? When you are looking at professional traders that have a huge amount of money invested into their financial freedoms and flexibilities in the future, I can guarantee you that they wouldn't fudge with a 20-point difference between the S&P and saying, okay, well, I'll just get into the trade at 1154, even though there might be a high that was truly at 1175. Anybody that is truly looking at this in the true forms of where prices were trading at is going to know what that historical level number was. Okay? All right. Yeah, yes, they do, Sam. They're all unadjusted. Okay, so anyway, I just wanted to spend, I know that took a little bit of time, but you can see this. And now for the last comment, and I've been getting a lot of emails about this as well. The last comment is, this is in relationship to the accuracy of these historical prices, and their value is extremely technically based on these index futures. Price seems to honor these historical levels on the contracts on the index futures. But I do not have enough information on the commodities market because, like I said, I've used eSignal, which has the unadjusted contract prices, for so long that I wasn't using TradeStation's 107 XN contracts ever on commodities. I wasn't ever using them on the currency futures, and I wasn't using them on anything other than this index futures. So I do not want you using the 107 contracts on anything but index futures. Don't use them on TY. Don't use them on the currencies. Don't use them on the commodities. Okay? We're trying to, as a team, give you accurate, precise information historically with us looking at it. Sam Evans and I are working on it. Philippe is trying to help with this. There's a lot of us traders that are in here doing this. We've found other places where we can go out there. You can go to futures.com. marketfutures.com, there's a whole bunch of different places that you can find free historical charts, and I'm trying to see by looking at those historical charts whether the data that we're receiving on TradeStation is accurate with the @ sign in front of it, or if it's more accurate with a historical level that's out there, but all this takes time. Okay, so just use the 107 XN contract on the current index futures contracts. Okay, and if you don't want to do that, and you all would like to use a different methodology, go back to the actual contract month itself and compare where the highs and the lows are when we start to get back. Okay? This is something that is so hard. It took me 3 years, which was almost 16 contract rollovers to start to feel comfortable with contract rollover. From 2002 to 2005, every single time that I would get into a trade during the week of rollover, I would just cringe at the thought. It felt like somebody was taking their fingernails and scratching it down the chalkboard, and I just could not stand the thought of rollover happening. So this is all just stuff that is helpful information that I found over my experience and doing these markets, that it's definitely something that you cannot forget. Now, with that thought, I'm even going to add one more thought to this. Okay, and I don't want to throw anybody off, but I'm sure to do this and mentioning this. Now, how many of you in this room with a green check mark are currently trading the M contract, the new contract? With a green check mark, show me who's trading the new contract. Probably the majority of you, if you are trading the M contract. Okay? Go ahead and show me with a red X how many of you are still currently trading the H contract. Is there anyone? Okay, you don't have to be scared to admit it if you are. Now, let's put some food for thought into our analysis. If you are using the M contract, okay, if you are trading the M contract, are the prices that are being reflected on your historical data from the past few months that we've been trading in the H contract, are they a reflection of prices that were traded on the H contract, or are the prices that you're looking at a reflection, as you're trading this new contract, are they the reflection of the new contract, or are they a reflection of the old contract historical levels? Absolutely. So, how many of you this week had difficulties? No, their actual prices are going to be on the H contract. The only new numbers that are truly from the M contract are from the time that you were starting to trade over into the rollover. So the only prices of the highs and the lows that are out there on this week's trading are from last Thursday and Friday, and anything from this week. Every other number that is out there comes from the H contract. Does everybody understand that with a green check mark or a red X? Okay, this is absolutely imperative that you understand that, because if you are looking at areas of supply and demand and you're looking for trading opportunities, okay, what do you think is going to be a consideration? I might have to look at the levels that were on the M contract, because the levels that I'm using right now were off of the H contract. And if I'm currently trading the M contract, then I might need to go back and look at the M contract historical highs and lows. If any of you find that you're having difficulty with the rollover and you're looking at making trades during that time, maybe it's because you're trying to trade numbers off of an H contract on an M contract. Okay? Am I speaking funny? Did I say something that was not English-like? Okay. But anyway, I never say any funny words like belly aching and puke in a bucket or anything else that make you all laugh. So I sometimes don't speak English. But anyway, the point in all this is that you have to be trading the levels off of the contract month that they were created. And historical levels that are out there before last Thursday are all the levels that were from the previous. Yes, Jack Nimble 107XN takes care of all of this. So that's the reason why the value is in the 107XN contract. As a trader, I used to have to pull up the M contract, the H contract, and then I would still have to decide, well, which levels am I supposed to be looking at? There's a level up here that's 5 points different on the H contract than that's on the M contract. All right? So this is to just try to help you all realize that the 107XN contract is really truly to help you save time, know where the historical levels are at, and realize that this is only applicable to the futures and the index futures. It's not applicable to any of the other futures markets that are out there. At least not yet. Until we get the rest of this figured out, I want you to know that the best thing to do is just trade that 107XN contract. Now, again, if you find some other things out there that are working for you and that 1154 level would have worked as a trading opportunity for you to get up to 1175, I can't argue with it. But again, hopefully this is helpful. Now, last 20 minutes. I would like to sort of open this up a little bit for some discussion. I've been in this room. I'm going to be celebrating my 1-year anniversary coming into XLT after Easter. I came in here 1 year ago in Easter time last year. And I know that many of you have been here for that whole year. Okay. First of all, it's been an exciting year for me. I've found that this has just been a very enjoyable way. It was something that I needed to be around people, and I love sharing what I know. And I think that it's been beneficial for a lot of people. But one of the things that I found over my 1 year in being in this room with you all is that there are still certain questions that are coming out routinely. And so as part of this last 20 minutes of discussion, and I would like some honest feedback, okay? I would like you all to help me in being a better educator, to help you all with what you think are some of the biggest needs, okay? And when I'm looking at bettering myself as a trader, bettering myself as an educator, the best source in doing so is from those who are around you every day and watch what's happening, and then you can help everybody along the way to just be a better trader, be a better teacher. And what I'm wanting to know from you all is, what is the one thing that you all seem to see as one of your biggest struggles? This isn't about me, okay? This is really truly about what can I do from my experience level to help you all as a trader, okay? What can I do to help you? What is the one thing that seems to be happening that you all seem to have the biggest difficulties with, okay? Now, how many of you would recognize that of anything that you all seem to have difficulty with, no matter how you name it or word it or say it, the biggest problem with all of us as a trader is psychological? Go ahead with a green check mark if you agree with the biggest difficulty as a trader is psychology. Absolutely, okay? And so the reality of it is this. In my year of experience here teaching in the classroom, and my years as being an individual trader and being around a lot of people, okay? What I want you all to realize is that there's only so many things that we can say the same way. The reality of it is you as an individual has to take on the responsibility of being accountable to yourself and accept that what you're doing is based upon what you have to base as a rule for yourself. Okay? A lot of times what happens is that people want to know what it is that Michelle Volmering is doing. They want to know what it is that Sam Seiden is doing, and they want to know what it is that Sam Evans is doing. Well, guess what? The reality of it is I could tell you exactly what I was doing, verbatim. And want me to tell you what would happen after I told you that? You would like what I was doing, but you would find one thing that maybe you want to change, and so you make a change to it. And now are you doing the same thing that Michelle Volmering is doing anyway? Because the reality of it is that if we were all doing the exact same thing, then this market wouldn't be able to be what the market is. The reason that the market works the way that it does is because there's multiple players that are out there using multiple different styles of trading. And all I want you to know about that is that it's okay if you're not doing what Michelle Volmering is doing. And it's okay if you're not doing it exactly the same as Sam Evans is doing. But the reality of it is as a trader, you have to be accountable to you. You have to write down your rules. You have to be able to be disciplined and patient to do exactly what you write. If you can't follow the rules that you put down, then it is not worth the lead that you used on the paper that you wrote on. Okay? So the one thing that I want you to do is I want you all to make a conscious effort over the next couple of days to write down things that you see as improvements to yourself in this room as a trader that I could truly help benefit you with, and send me those kinds of things in an email. Because I definitely want to make sure that when I come into this room that it's worth your time. And days like today when I share with you, this is the reason why I take targets at these levels. This is the reason why I'm always talking about the low risk, high probability trades. Because I'm not looking at all that stuff in the middle of it. Okay? We absolutely want to make sure that you understand. Okay, now there are different trading plans, there are different trading styles, and there are different things that you have all been taught. But in the reality, when it all comes down to being said and done, at the end of the day, the only person that has to be accountable to you, the only thing that you have to do is make sure that you can fully accept the responsibilities of what you've set yourself to do. And if you can't handle what you put out there, if that risk is too big, you don't take it, no matter if Michelle Volmering could. Even if you like that she likes those bigger profits, but that isn't going to fit within into your account and what your trading capabilities are, then you don't do that just because she said that. All right? So send questions specific to, and label it in the SME, specific to XLT-support, and label it as suggestions. All right, these are things that I feel would be beneficial. Now, I'm not going to be able to go out there and answer every one of these in a 48-hour period of time, but I do want you to know that you can send an email to me, and I am more than willing to try to make some adjustments to see how I can help you all. Let me just tell you for a few minutes, we've got a little bit of time, about some of the changes that we have worked on, that we're coming into implementing in this futures class. We're coming up with more detail in the lessons. We're having a curriculum that is going to be very well outlined and formatted. You can expect that the instructors are going to be using the same styles of charting platforms. We're going to be using the same color lines. We're going to be using a lot of very much more customized detailing in every session by every instructor. So we're trying to make it so that everybody's doing the same thing. All right. Now, we all have our own little, we all have our own little personal ways of explaining things. We all have our own little nuances of how we tell you that we're looking at it. But the reality of it is that if you all want to be consistent and you want to have that information that is gonna help you the best, we should all be on the same page. Okay. So, anyway, I just wanted to spend a few minutes time talking about that. I really think that it's important that you all realize that we're going to start spending more time doing live trading. Okay, we're going to pull up the TradeStation charts. We're going to pull up the matrix. And when we start telling you on a lesson day about a trading strategy, we're going to show you where the stop and the entry and the target is going. And when we see that setup and we tell you that this is a good trading opportunity, we're going to place it in the trade. Okay, you'll be able to see it, and we're never going to trade more than 2 contracts. So for those of you that think you have to have big accounts, no way, that's not what we're going to be doing. We're going to start so that even the smallest person is going to be able to see these live trades in action. We're going to have more days where we're going to be talking about your trades. For those of you that are willing to go out there and send an email in the iSupport and you're wanting us to look at the trades with you and say, hey, how come this trade didn't work? Hey, take a look at this trade. Look at it. It followed the rules exactly like they said in the class. But we're going to do more of this. You can expect more recognition to the students. You all are going to be able to be recognized as students of the week, students of the month, being able to actually participate in some of the lesson days if you so choose to. So there's a lot of wonderful things coming down the pipeline, okay? And I just want you all to be aware that we're truly interested and we are here for you. We've all been where you are. There's a starting point that everybody comes from, and we all know that everybody in this room is here for one reason and one reason alone. We want to successfully be able to make money trading every day, every week. Whenever we have a trade out there, we want to be able to know that with confidence. All right, and so that's what this whole thing is about, why I'm spending more time talking about your understanding of the 107XN contract, why I'm trying to show you these targets. It's because these are the emails that come in, and I see frequent emails on more than 3 to 5 in one topic. We're talking about it in the class. All right. As someone so eloquently stated a few months ago, you are the angel on my shoulder when I'm trading. Well, Bob, thank you very much. I'm just telling you all that this is truly, you know, been one of the best experiences of my life, and I knew what I was capable of going out there and sharing with others. I only wish that I would have had that from somebody else when I started trading. It's been totally one of those things that I made a commitment, you know. I don't even want to get too sidetracked, but I definitely made a commitment, and many of you know that I said, if I ever get this right, dear Lord, I'm going to go out there and share it with anybody who will listen to me. So you all you get the benefit of all of that. All right. Any further questions about the 107XN, the targets, anything else that you all want me to talk about? Shib says, Michelle, I use eSignal. There was a spike on the last rollover day, but when I look at the continuous contract, supposed to be unadjusted on eSignal, the spike is not there. But if I look at ESHO separately, the spike is there. Could you please comment on that? You know what, Shib, if you'll send me, an email on that, I'll be able to answer that. Most people in this room aren't using eSignal, but I can answer that to you privately. Michelle, can you scroll back to my question regarding rules? It's important for all of us. All right, let me scroll back. Okay, Jeff Cronenberg says, exactly what rules should you have? The turtles, for example, had rules. They followed them and were successful, but at least they had some rules. They followed them and were successful, but at least they had some rules given to them. I've lost so much money trying to come up with rules. Perfect, Jeff. Picking those rules is defining the details of the strategy. I'm still trading on Sim until that is set. All right, so let me answer that question. I think that's a great place to start with. Okay, rule number 1 in trading, like everything else in life, don't even attempt to go out there and do something in which you have no experience in. There is no way that you could ever put me in front of a patient and expect me to put in an IV in them until I had some sort of an experience level with them and I understood it. So rule number 1 is do not put any of your money at risk as a trader until you are fully aware of what it is that you are doing. The largest amount of failure comes in trading in that we try to go out there and just start pushing buttons based on the things that we think. Okay, based on taking one class, now we've suddenly become experts in the market and we want to go out there and put our hard-earned dollars at risk. And any time that you think that you are ready to go out there and put your hard-earned dollars at risk, you better be able to have something to back it up. And so for me, I believe, and this is just, I wish somebody would have given me this rule. Rule number one is never start trading until you know what you're doing and you have something to go back and look at. Okay? Now, I know that some of you may not want to hear that. You might say, okay, well, I've just invested X amount of dollars and now you're telling me don't do anything until I know what I'm doing. Well, aren't you here to help me and tell me what I'm doing? Yeah, the reality of it is I'm here to help you, and I am going to decrease your learning curve. If you would have had to sit here and figure this all out on your own, it would take you years. Now it might only take, let's say, a few months or maybe a little bit longer, maybe a year or so, but it's not going to take you years and years and years like it did me. So that's the first rule. Jeff Cronenberg says, the hardest part about doing this on your own, without say working at a company where you are trained, is coming up with the rules. OTA says come up with the rules, but it's hard to just come up with your rules when you have zero experience. You can only afford to lose so much money in order to learn how to do this. It would help if we could get some help somehow with the rules. Sometimes I'm not even sure what rules are for trading. For example, as a rule, I won't trade the open. Or are the rules more specific to how to manage your money once in a trade, or is it both? Great questions, okay? That's good, Sam. Thanks for being here. I'm glad that you could help me. And I'll be in touch with you. I'll see you tomorrow. So anyway, for those of you that need to leave, I won't be offended, but I just want to spend a little bit more time talking about this because I think that it's a wonderful question. Now, let's talk about rules. And you know what, Jeff, we could actually try to maybe even put in a lesson day about rules for trading. But let me just give you an example. If you'll just hold on 1 second, I'm going to actually go in and pull up one of my big long list of rules that I have included as part of my trading plan. And you know what? I'm like you. I didn't have somebody to share with me my rules. I had to figure them out on my own. And it took me a while to figure out the rules. But let me just share with you an example of some of my own personal trading rules. Now, the reason that we can't all give you these rules is because as a trader, some rules that are out there for me might not be applicable to you. You might not have a problem that I have. You might not have a problem holding on to a trade and letting the stop work, but you might have a problem with holding on to the trade and letting it get to the profits. You won't adjust your stops. You'll leave it alone and you'll get into the entry at the right place, but your problem isn't anything to do with entry and stops. It's all to do with targets. So one person's rules might be a little bit different for that reason. It all comes down to what it is that we personally have to be accountable to ourselves for as traders. And the only way that you know that is to start going out there and recognizing after you do trade what you think you know is then to form rules around it. So a portion of this, Jeff, cannot be answered before you start to actually do the trading. Some of it is very generic and very basic. All right, so let me go in. I'm trying to find on my chart here, in my computer here, the rules that I have in place. Microsoft Office. I'm still here. Okay, so these are just a couple of the examples that I have in my trading law and my trading rules. Okay? Never trade without a stop, a hard stop. Okay? Now, let me tell you the reason that this rule is in one of my rules. It's because when I used to trade, I would get into a trade, I'd get stopped out, and having been stopped out a couple of times at a level and then watching it go exactly to where I wanted to, I started saying, that's stupid, I keep getting stopped out, and then it goes exactly where I wanted to. Well, what about the one day that happens to be a trending day, and then you don't put a stop in there, and it doesn't have a bounce off of that level, and it doesn't stop going down, and it just keeps going lower and lower and lower and lower. Okay? So the first thing that I have on there is always use a hard stop. Yeah, I don't have them posted on there. It's not out there. I'm just telling them to you. The second thing that I have out there is that I only take 3 trades or less a day. 3 trades a day or less. Now, why is it that I'm interested in only taking 3 trades a day? Because Michelle Volmering used to have this habit when she was trading the S&P future, SPY and the Qs when she was trading the ETFs, where in 1 year, she spent $40,000 in commissions. Whoo-hoo! Imagine that. More than what some people make in an entire year on an income I spent as an expense to the broker on commission costs. Does that say something about the reason why I might only want to limit myself to the number of trades that I take on a daily basis? Because I was such an overtrader and I was scalping so much. This was back in the late 90s. Okay? I was scalping so much that I paid such a large amount of money. Okay? So, if I'm going to get into the S&P futures, and this is across the board on any instrument, I will not take more than 3 trades in one instrument. Okay, Julianne? So if I have the S&P futures and that's my day trading style, I will not take more than 3 trades. Okay? Now, the next thing that I have out there as part of my rules, and this is all very specific, reduce my contract size during contract rollover. Reduce my contract size during rollover, no matter what the case is. No matter what it is, I do not care. I always reduce my contract size. If I had been trading 10, I'll go down to 5. If I had been trading 3, I'll go down to 1. If I had been trading 7, I'll go down to 4. I try to split it somewhere in half. The reason is because no matter how good I am, I still have a difficult time during the contract rollover. It just seems that during this period in time, I seem to go back to my log and find that I was struggling as being successful during this 1 week. So instead of saying I can't trade, I just reduce my size. The rollover period is from the second Thursday of the contract expiration until the expiration day. So last Thursday to this Friday is the rollover period. Now, yes, that is right, and it's only 28 days in the year, so that is one of my rules. Another rule is if I lose more than a certain amount of dollars, now this is something that is debatable among other instructors and among other traders. They won't put these kind of limitations on themselves, but I do, okay? That's right, Tony. In other words, save your bullets. One of the things that I do is I put a dollar figure of an amount of money that I can lose on a daily basis. So if my 3 trades is not hit first, but my maximum dollar is hit first, then I can only take that 1 trade. So if I hit my maximum dollars first, then I can't take a second or a third trade. So some of these rules are dependent upon another one. So I better be making sure that I'm following these rules. And if I can't follow them, then I don't even write it down. Okay. Another rule that I found over time is beyond even more important than that is that I had to go in and I had to make sure that I gave myself a maximum amount of time in front of the computer. So in my rules, if I'm day trading, and this is truly why some of the XLT sessions become a little bit challenging for me is if I'm trading, I never allow myself to be into a trade from the open beyond noon. I never trade in the afternoon. My other rule is there are only 8 days of the year that I trade in a new position in the afternoon. I will never enter a new open position afternoon except 8 times of the year. Does anybody know what those 8 times of the year are? One event, Fed Day, absolutely. So those have all come that, in my experience, of all of the information that I've acquired over time, and there's many other things that I take into consideration. That's all part of my strategies and with my setup and my risk management. But these are hard, fast rules that I never ever deviate from. I have to put in a hard stop so I don't have the losses. I have to make sure that I'm not over trading. I have to make sure that I'm not trading in the afternoon because what would happen to me was I would make money in the morning and give it back in the afternoon. If any of these things sound familiar to you, then you want to write down those as part of your rules. The rules are different for me, though, than what they might be for you, Jeff. And they're different than what you might do from a risk management standpoint, okay? And that's where I think your question, oh yeah, see now as I'm saying it, you're referring to it. I think I'm referring to risk management, entry, exit, and setup rules. So I think that this is a good thing to talk about. You'll see more about this, and I'll elaborate a little bit further on this. Let's say that you all do put some rules into your risk management, money management, trade management. The rule is this. I am going to put in a trade, and I'm only using the S&P because many of you have experience with this or watch us trade it in the room on a routine basis. But let me just use this as a rule that I have in my S&P trade. If I enter into a long position and the market has not moved 3 points in my favor and starts to come back to my entry point, I know that there is a larger possibility of me being stopped out. So I will take that stop out, but I will not re-enter into another trade long until I have a confirmation of that 3-point break and I wait for a pullback. Did that confuse anybody? So my first rule is I look into getting long in a trade, and I'm going to put a number to it. Okay? I get long in the S&P at 1104. Doesn't matter what time frame. Okay? If I enter into that trade at 1104, I leave my stop where I know I'm wrong, and the most I'm willing to risk on that trade is 3 points. But if I got into a trade long at 1104, what would the market have to do in order to prove to me that I was right, at least initially in this move? It would have to move at least 3 points in my favor. So it has to move to 1107. As soon as 1107 is broken, then I know that I'm okay. But if I get into that trade at 1104 and I get stopped out and it sits there in basis sideways, I cannot get into that trade until I see some confirmation, and that confirmation is a 3-point move. Now, what does that do for me? Why is it that that's one of my risk management rules? Because it avoids me from having that need to keep entering and buying down at that low, taking another stop out. Does that make sense? As long as it takes, Harold. Might take a week, excuse me, it might take an hour, might take 15 minutes, but until it breaks out of 1107 and that long, I am not waiting. I am not going to re-enter into a trade. And what this will do is it'll force you to make the market prove to you what's happening. So let me do this. I have this chart up here. Let me go back to today. Uh-oh. Looks like it's reset itself. darn, I'm not going to be able to do that. Okay, what I was going to share with you is my radar screen that I've shared with you in the room many times before on the 5-minute, the 1-minute, the 15-minute bar. What is it that happened today on the S&P? Okay, somebody, does anybody have their numbers written down on the 1-minute, the 5-minute, the 15-minute bar highs and lows? You don't have to. I can go over it with you. And again, I won't be offended if anybody leaves. I know I've extended this out a little bit longer, but I do feel it's beneficial. What was the 1-minute bar high on the 9:30 open and the low? Just post it in the room for me. 1158.75, and what was the low? 1157.50. So, what was the 5-minute bar high? 1159, and was the low the same? Okay, 1157.50. Now, what was the 15-minute bar high? Same thing, 1159.25 and 1157.50. So now let's just say that the market had an entry for you to get long. And you got into this trade somewhere between 59.25 and 57.50. I'm just going to use 11.58 because it's a round hole number. No particular reason, just because I like it as in the middle of that range, and it's an easy number to remember. So let's look at 11.58. Now, if I entered into that trade at 11.58, what would be confirmation to me that it would have to go, that I would have to wait to get into a trade in order for me to ever even think about taking a second trade if I got stepped out? What would the number be that I would have to break out of? Absolutely. So this is a risk management rule, because if I take that trade the first time at 11.58 and it can't get to 11.61, but then it starts to come back down into 11.57.50 and I whack it again. What happens if I whack it again at 11.57.50 and now it only gets to 11.59? Did it move 3 points? No. So for me, on any entry that I get into, I like to see that the market is moving in that away from me and do it again, only to get back into the trade if I've been stopped out once I see that that move of that confirmation has occurred. Whack it again means I'll enter into the trade long again. I'll take another shot at a long. Otherwise, I stay away from any long entries. So I'll take one stop out on that long. And if it hasn't moved 3 points in my favor, I would never even think about getting into a trade again long. Okay, that's what has to happen. And if it's beyond my entry point and it's far enough away from where it's a profitable trade and the risk is too high for me to get into it, I'll stay away from it. Okay, now, the second rule on trading is that after the market has moved 3 points in my favor and it has not hit my target, my big picture target, that supply zone that we were talking about, I will wait for the exit of the trade to get out of it with a stop out. At the low, I will wait to get out of it only if it has not had the ability to move more than that 3 points. So what do I mean by that? Okay, if it's moved 3 points and I've gotten in that trade and I've got a supply level where I want to be able to take a profit at it, I have a rule that says I cannot exit out of this trade at a break-even point unless it hits my target. That's my rule. You all know that I want to get out of the trade at my target. But once it's moved 3 points in my favor, I start to say to myself, if it can't even get to my target and it starts to come back down to my break-even point, then I'm just going to have to refrain from getting into another trade. Again, even though the 3 points has gotten there, but if it cannot get to my profit objective that is a decent supply zone, once it starts getting back below that low, I won't take a trade there again. It's the same thing. So in the event that same exact numbers, 1148 was my entry, my stop was below the 1147 area, okay? If it gets up from 1148 entry and it does move to 1151, it has moved my 3 points, but my target is all the way up at 1160, okay? Now, if it cannot continue to move out of 1151 and continue traveling up to 1160, I still don't move my stop, but I leave my I leave myself that rule that says you still do not enter into another trade long, because once the market is moved in my direction and it's coming back down to my entry point and going below it, I do not take another trade long. So if I've gotten into a trade at 1148, it's moved 3 points in my favor, and it's come back to my entry point, and I take a stop out, I'm not looking for another entry long for that very exact same reason. Because even though there was strength initially and looked like it had moved 3 points, once it gets back to my entry point and it starts to stop me out, I'm not going to take another long. So let's talk about today. Somebody was asking about this, and I want to wrap some numbers around it, and then I'm going to be quiet and stop for the day because I think you guys are going to be a little bit overwhelmed. But I just want to talk about what happened with today's trading since we wrote down those numbers specifically. Now, first of all, somebody tell me what was yesterday's high. Yeah, the same thing for a short. So let's think about what happened yesterday. What was the daily high on the S&P from yesterday? Okay, somebody's got 1155.75, somebody's got 1155 quarter. Are we talking about the M contract, 1155.75? Just making sure we're on the same page. Okay, so with 1155.75 as the high of yesterday, when we observe what was happening in the first minute and 5 minutes and 15 minutes, somebody answer me the question, were we trading above 1155.75? Yeah, we were. So when we're talking about higher highs and higher lows, did we break above higher highs and higher lows? Yes. So immediately, my first thought process is, as a trader, I need to be looking for pullbacks because this upward trend seems to be continuing. What would have been a really good area for me to think about getting into a trade long this morning? If I could answer yes to that question in the first 5 to 15 minutes of the day that we were trading above a previous day's high and we were looking like we were going higher, what would have been an area where we could have been thinking about getting long? Q says the Globex low. So answering that question, what was the Globex low? Okay, 1154. Now, if 1154 was the Globex low and the previous day's high was 1155.75, and we know that a previous area of resistance oftentimes becomes an area of support, could we have wrapped around some lines in our thought process saying to ourselves, somewhere between 1154 and 1156 area, maybe even 1157, might not be a bad area for us to think about getting into a trade long today. Why? Because the Globex low was at 1154, 1155 area, 56 area is trading above yesterday, and if it just comes back and retests that area, I won't have a whole lot of risk. No more than 3 points, because if it starts going below the Globex low, I won't want to be going long. Is that acceptable for you all to understand that you can write that as a rule? That if we start trading above a previous day's high, I'm going to look for a trade on a pullback as close to the Globex low. Okay, that's a rule. I'm not saying that this is what you could do, but you all are asking me, how can you use risk management from a rule-based strategy off of something that you have written down to be proper risk management and proper money management? Look at this trading opportunity. When we go back and we look at this, knowing that that 1154 was the low, at 8:15 this morning, 8:20, and 8:25, right before the report came out, the low was 11.56. And on the open this morning, on a pullback at 9:25, we had a low of 11.57, and then we had a low of 11.57 quarter. So somewhere between 11.54 and 11.57 quarter, we had a 3-point range where the market was telling us if we start to get above yesterday's high, that might be something that we want to take into consideration for today. If you go back and you look at your 1-minute, 5-minute, 15-minute bar lows, have we ever gotten back to the lows and broken below them? No. Have we broken above the 5-minute? Yes. Have we broken above the 15-minute? Yes. Have we broken above the 1-minute? So you mean to tell me that if you would have been willing to put 3 points of risk below 11.54 from the 11.57 area from the lows, now you're saying to yourself, hey, when it starts breaking out of the highs, I've got to be knowing that this market has a further confirmation of a move up. And as long as it never gets back below the day's .D low, I don't even have to worry about the Globex low. Now, how much of a reward potential would you have thought of being able to obtain today? What was the next number that was on our bigger picture time frame? We looked at it on the daily chart. We looked at it at 11.75 on 11.73 and 11.75. So you mean to tell me that you might have been able to get into a trade with 3 to 4 points of risk and looking for a profit objective up at 11.73 to 11.75. Now, I don't know that it's going to get there. Michelle, how do we know at that time that it was never going to go lower? You don't, Kelly. You do not know that. And so that is why you ask yourself the questions. Am I putting in higher highs and higher lows? The answer to that was yes. Am I in an uptrend? Yes. Am I in a big picture uptrend? The answer to that is yes. Okay? Why are you thinking that we're going to have a reversal on a supply level Q? Okay, I'm not making anybody feel inadequate. Hopefully, I'm just trying to answer the question. Remember that the thing that we need to be thinking about, as I told you, when we're looking at these swing trading opportunities, look at this movement. On this daily chart, we have not had any pullbacks. And when we look at the difference between the swing point highs and the swing point lows, and we then move away from this and we start to go back to bigger picture time frames because this swing point has been violated. This swing is no longer in control, and we know that this one isn't even in control anymore. What had been a low and a high, that one has been violated. So now we have to go to a bigger picture swing to identify where the next profit objectives are. Does everybody see this? Actually, 11.75 is just a small little stepping point on a daily chart. But bigger picture, if you're long above here and the market continues, you actually could hold on to this all the way for 1,300. We're taught that it's novice buying after a big move up. Well, it depends on the amount of time that you're going to hold on to this trade for. Okay? We're also taught that in the bigger picture of the scheme of things, from the high to the low, that if this swing point breaks out and it continues its upward movement, and I only even have one contract, I can make the difference between this extreme high all the way back up to 1,300. Would I be willing to risk 4 S&P points to go to 11.75 and maybe even 1,300? Okay? The reality of it is I wouldn't be looking at 1,300 as a day trade. I wouldn't be looking at that big of a profit level. But coming off of 11.60 and breaking out of the highs of 11.59 that were put in on a 1-minute, a 5-minute, and a 15-minute, I would reasonably expect that 11.75 is attainable. Why? Because the S&P has typically been moving. Let me share this with you, and then I'm going to end the day. Go to mypivots.com, the website, under Daily Notes, I'm going to application share this. And you'll be able to see that the S&P has been moving in a big 11 to 14 point increment. On a daily basis. And so that if it moved from 1160 and it moved its average range on a daily basis somewhere between 11 and 12 points, maybe even a little bit more, 15 to 17 over the last 60 days, that I might be able to achieve from 1160 back up to 1172, 1173, 1175. Does this make sense? With a green check mark. Okay? Even if it is, that's the only one that they have, Q. They don't have M data on this one. If you go back, I think. Maybe I just overlooked it. See, this is H. Maybe they have M down here somewhere else. Oh, it's over here. They changed the layout of it. Yeah. Okay? So go over and look. Still the same thing, 1065, 12 points, 16, and 14. I mean, the reality of it is that throughout all of this range, it's somewhere between a 10 and a 16 point range. Okay? Yeah, this H10 will end on Friday. Absolutely. So I hope that you all found this beneficial in setting some rules. You can enter into a day trade, even on a breakout, trying to grasp the low of the day, and as it's breaking out of the high of the day to the next profit objective. But the reality of it is that you got to remember that you're trying to buy in a longer term extended range. And if you look at it on the weekly, it says, well, you know what? I might not be so far out of off my rocker be thinking that I could get that far, because there's a level of 1300 all the way up. All right. Anyway, everybody have a great day. Hopefully you found some value in this. And again, I encourage you all to ask the questions and hopefully look forward to the changes that are coming in place very soon with XLT. All right. Have a great day. All right. So as you come in here and you look at this on this weekly chart, even though we're on a high profit curve on the daily and it looks like it's extending high into a supply level, we actually have a high profit curve at 1575 on the weekly with a double top, a rally base reversal pattern, and boom, a huge drop away from it with 665 as the low. Now, are we in the high profit curve of a supply zone sell here now? No way. As we start to move up in here, we realize that the higher profit curve levels are going to come back down as we start penetrating up much higher. And so I'm going to just tell you that make sure that you are sticking with the trend and your trades. And if you'll go back from February 5th, I challenge each of you in this room to do this today. Go back and look at the number of times since February 5th on the S&P that we have had higher highs and higher lows in comparison to lower highs and lower lows. Okay? You have to realize that what I'm telling you is absolutely critical. Okay? Higher highs. Here's the February 5th. Higher high, higher low. Higher high, higher low. Higher low, but a lower high. Higher high, higher low, higher high, higher low, same thing, continues. And we just keep putting in. This one day right here with the doji had a little bit of a lower low and a higher high. Lower high and lower low was this red day, and then a lower high and a higher low, and then the doji, another lower high and a lower low. That's 2 days that we had a lower high and a lower low. We never had another day with a lower high and a lower low till right here, and then right here. In all of this entire move, we've only had 4 days with lower highs and lower lows. And every day that followed after it, it continued to rally on up. So please make sure that you all are watching to see these kinds of moves. Just go back in a chart and look. Higher highs, higher lows. As long as you continue to have higher highs and higher lows, And really, one aberrancy in the market with a lower high and a lower low isn't a change in the direction. When you really start to think that there could be a change in the market, you have continuing days with lower high, lower low, lower high, lower low. And it's not until the swing point low gets taken out that you have the confirmation. So please do not disregard the trend. It's the best thing that you can look at. And I think that's why some people have so much difficulty. If looking at the profit curve doesn't work for you, then you don't have to use it. It might work and help other people, but if that's not going to be beneficial for you, then don't worry about it. You know, there's things that other traders use that I don't like. And I don't have any problem saying that. I don't use fib numbers. I don't use a lot of these other extra tools. Sure, somebody else might find some value in it, but it's not helpful for me. So looking at this move, let's look and see what happened right here, okay? We go back to the lows that were being created on the swing point. And we see this high that was being put in, okay? Market was still in an uptrend. From the time that this low was put in, broke out of that extreme high, market continued with higher highs. On this pullback, did we come back into retesting this low level? The answer to that is yes. Did it penetrate all the way back down into it? No, but again, as long as these lows never get taken out on these swing points, as soon as we start getting back up above highs and we can't fail lows, we've got to start thinking about the change in the direction back to the upside again. All right? Yeah, don't you like it when somebody says this is an unsustainable rally? And don't you like it when somebody says, oh, this is weakness and the market is going to turn directions? I cannot tell you how many times that hurt me as a trader, okay? So again, this is definitely going to help you. Yeah, I'm sure of it, okay? Go back and just look at it. It really, ask yourself this question. Where did the last buyer buy before price turned up? Where did the last seller sell before price turned down? And you've got to look at it. And you're not trying to predict it. Stop trying to predict where you think the turns are. Let the market tell you where the turns are and wait for it to come back to that level. That's the part about patience and discipline that everybody has the most difficult time with. The reason we hurt ourselves is because we go out there and try to predict where the turns are. Where did the last buyer buy before prices turned up? Where did the last seller sell before prices turned down? And it's always going to be at those extreme highs and extreme lows that are occurring at those swing points. Okay? That's why these are highlighted. Every one of these swings has to be broken through in order for an uptrend to continue on the high side, and every one of these swing point lows have to be broken in order for confirmation of a downward move. Okay? Jeff Cronenberg's asking about the NASDAQ, and again, I've got to get into the other room. I'm 3 minutes late, so let me go in and look quick at this NASDAQ. Okay? You're looking at this coming into a supply level on a bigger picture time frame. Okay, here is coming up into a supply level on a weekly. Was this an area that the market had been to previously and then had a sharp drop? Sure. But you know, instead of just, and I'm not telling you not to take that trade, but what I'm saying is if it fails, don't be surprised, especially if it's continuing its move on higher highs and higher lows. Oh, I'm sorry, Mark, it was you, not Jeff. Thanks. Okay? Because there's this swing point high to the swing point low. There's a pretty good chance prices could turn at this level, but if it doesn't, it's because there's another level that's even higher that in the bigger picture swing from the extreme highs, we have another level that's even better. Swing point high, swing point low. Once the swing point low was broken, look at what happened with the market. Sure, it tried to come back up here, could not. Now, I don't have a problem with taking this, But from my standpoint, I'm going to be much more willing to wait for some of these other areas. If that level gets broken, I'm not necessarily just going to take a short here, but I will take one up here a little bit higher. Anyway, that's it for me for today. I've got to scoot to the stock mastery room. Okay, go ahead, Mark.